Hey there, this is Arthur Hill, Senior Technical Analyst with StockCharts.com. It is Tuesday, January 29, and you're tuned into On Trend, the show designed to keep you on the right side of the trend. So we're kind of in a precarious spot when it comes to the stock market because we got two competing trends that I'm going to go over. The short-term indicators are holding up, but I still think longer term we're in a downtrend. And we're going to focus on some short-term patterns that are taking shape in SPY, QQQ, and IWM. Then we'll look at key supports for the sector and industry group ETFs to watch going forward, and we'll finish with the intermarket arena. So before we look at some of this price action, let's look at the short-term breadth indicators. So one breadth indicator I've been monitoring is the percentage of stocks above the 20-day EMA for the four major indexes: S&P 500, S&P Mid-Cap 400, S&P Small-Cap 600, and NASDAQ 100. And basically, when this indicator moves above 70, it becomes overbought. But as we know, an indicator can become overbought and remain overbought if price does not turn down, so to speak. And that's what we're seeing here. We can see that this indicator for the S&P 500 became overbought there in the first week of January when it moved above 70. And it's been above 70 for over 2 weeks now as it remains overbought. So there you can see the point at which it became overbought when prices moved roughly above 2,500, and then we continued higher. So overbought is still a sign of strength, and it's not until this indicator turns down and breaks below 70% that we have some sort of a sell signal from the indicator. So if we look at each four of these indexes here, you can see that the S&P 500 is at 82.8%, so it needs a little bit of work on the downside. The mid-cap indicator is at 86.75%, so it's still well overbought. Small caps are the weakest. Only 74% are above their 20-day EMA, and then you can see 81% of the NASDAQ 100 stocks. But in general, I think if two of the three of these top ones, the S&P 500, S&P Mid-Cap, S&P Small-Cap Index, if two of the three break below 70, that would show enough short-term deterioration to suggest that the short-term uptrend is reversing. Now, I should also quantify this or qualify this because I am only looking for a bearish setup because I think the bigger trend is still down. I'll get to that here in a minute. Now, the second indicator that I'm talking about is the percentage of stocks above the 50-day EMA. And it is sowing a little bit of confusion into the marketplace. So we put out a video, the Stock Charts commentary team, on what to look for in 2019. And one of the things I was watching for was some sort of a big breadth thrust. And yeah, we got that with the Zweig breadth thrust in the early middle part of January. And you can also see the percentage of stocks above the 50-day EMA here moved above 70% for the S&P 500, the S&P Mid-Cap 400, but not the S&P Small-Cap 600. So we had two of the three moving above 70%. And I said if we move above 70% in two of the three, then that would show some serious participation on the upside and would be bullish. Now, I'm at that point, but if I look at other evidence out there, because when you're looking at the broader market, you always have to take a bulk of the evidence approach. You have to take a weight of the evidence approach. And this is just one indicator. So I know we've got this wide breadth thrust. Now we got the percentage of stocks above the 50-day moving above 70%. But we're still below the December high. We're still below the 200-day moving average. And we haven't even recovered the previous decline. That previous decline is still bigger than the current advance. So I'm going to put this indicator on hold. And at the very least, a pullback would be warranted after the big advance we've seen since December 26th. Now, this third indicator is showing 80%. And that's advances plus declines divided by total issues. And it shows you basically participation on any given day. Now, I've got three red boxes and I've got one green box. And what I've got here is I've got horizontal lines there at plus 70% and minus 70%. And that's kind of like a short-term threshold for a breadth thrust to the upside or the downside. And so basically, the most recent one is kind of like the last thrust or the last signal. So you can see here in late December, we had that thrust above 70%. And that negated those negative thrusts. See, I had one down there in early December. And so we had one in late December. And we stayed until we got that bearish thrust in the latter part of January. This is the S&P 1500. That puts all three of those market cap indexes together: 500 stocks, 400 mid caps, 600 small caps, 1,500 in total. This is about as broad of a breadth indicator as you can find. And so currently, I would consider this one on a short-term bearish signal, if you will. Now, if you break it down, you can see the S&P 500 didn't go below 70%, but you can see the S&P mid-cap 400 did, and the S&P small-cap 600. And then when we had the big advance on Friday, you can see that none of them got back above 70%. All three of them held below 70%. So that breadth, that move we had up on Friday didn't show a lot of participation or a lot of confidence. So that's why we're kind of in this, we're really in a limbo, and you'll see it on this next chart as we battle two key moving averages. So I'm calling this Battle Royale, and it kind of reminds me of the scene in Pulp Fiction when they're talking about hamburgers and what do you call a quarter pounder in Europe? Well, obviously they're using the metric system in Europe, and they call it a Royale with cheese. But we clearly have a Battle Royale right now in the market because we've got a long-term downtrend in play. All four indexes are below their December highs. That was the last significant peak in the market. All four are below their 200-day SMAs. In addition, the 50-day SMAs are below the 200-day SMAs, and all four hit 52-week lows in December. Now, on the plus side, we got some short-term bullish signs. We've got all four above the 50-day SMAs and all four above short-term supports. And that is what I'm focusing on right now, is these short-term support levels in the QQQ, SPY, and IWM ETFs, as well as in some sector and industry group ETFs. So here's a chart that basically sums up the state of the stock market, if you will. We've got all four major indexes. We've got two competing trends at work here, and both are strong in their own right. But if you look at the downtrend, which is the longer term trend, this move from October to December is clearly a bearish development. All right, we had a 52-week low. The last decent reaction high was in December, and we're still below it. So we've had this monster advance, but we're still below that high. We're still below the 200-day, and we hit a 52-week low there in December. And that's the case for all four of these major indexes. All right, mid caps, small caps, NASDAQ 100. Now, short term, okay, we've got some uptrends as I showed you, and that's where I'm kind of focusing on. I'm being more tactical at this stage than strategic because I think that, the market direction could change, and it could change quite quickly. My guess would be maybe we have some sort of upside pop and then a reversal because, we got the Fed, we got the China meeting coming up this week. So, well, at the very least, we're probably just going to get some volatility. But if we look at the short-term patterns developing in SPY and QQQ and IWM, we can see basically four gaps in 6 days. All right, we had a gap up, we had a gap down, and then we had a gap up, and then we had a gap down. So that's basically four gaps. And then we've pretty much gone nowhere despite these four gaps over the last 6 days. So depending on what happens here, this is a very sharp advance, 14%. And now we got what looks like a pennant formation here. That's that little triangle. And typically that's a bullish continuation pattern. And I'm seeing a lot of little pennants out there and flag type patterns after this big advance. And technically, if we get a breakout here, that's going to be bullish. and that opens a door to a challenge to these December highs. So, 278 area for SPY. Now, as far as the short-term uptrend is concerned, the key level, of course, is the lows from last week. And if we break 260 in the S&P 500, and if RSI goes below 50, that would be a short-term bearish development. So you got to stay on your toes. And I have to say the odds of whipsaw may be above average with the Fed and the other meetings that are happening this week. You look at QQQ and you can see a similar situation. There's the gap up, the gap down, the gap up, the gap down. And overall, you just have a consolidation. And we're watching for the direction of the break. But, if we fill yesterday's gap and get a breakout there around 165, that opens the door to the low 170s for QQQ. And if we break support at 160, that is going to be a bearish development. Now, if we look at IWM small caps, and they're actually holding up a little bit better yesterday. So what I drew here was kind of like a small flag pennant thing. And, maybe you have another one here too, some sort of a small flag there and a breakout and a little throwback and a little gap breakout. And this gap breakout's holding for the most part. So I would put small caps net bullish as long as they hold that gap. But, if they break support here around 143 and change, that's going to be a bearish development. And if RSI breaks 50. So watch these three. 2 of the 3 break support, then we have a short-term trend reversal on our hands. So I like to break down the market, and the first breakdown I use is at the sector level, looking at the 11 sector SPDRs. 8 of the 11 are below their 200-day SMAs. The only 3 that are above are utilities, REITs, and healthcare. All 11 sectors are below their December highs. So we had that big decline in December, big advance in January, but we haven't recovered from that decline in December in any of the sectors. REITs, man, are on a tear. There are over 20 new highs in REITs, and I'll show you that in a minute. And then we look at the industry group level. We have housing and sky, cloud computing and internet and semiconductors exceeding their December highs. But we can see that, retail and the biotechs and the oil and gas equipment services, SPDR, did not. So to find these REITs hitting new highs, I went to the Predefined Scans page. And you can find that. You got the charts and tools page, which I'm on right now. And on the right side, you have navigation links. And if I scroll down to additional tools and reports, and then to Predefined Scans, and I can click that to be taken to that page. And I will see scans at the top, bullish technical indicators. And then below that, we have bearish technical indicators. And you can see that there were more bearish technical indicators. That's the change in the number of indications or scan results from the previous day. And then you have candlestick patterns below that. So there's a whole wealth of information there for you to find signals for individual stocks and even mutual funds. What I'm going to do here is I'm going to go up, and we've got new 52-week highs, and I'm going to click on that total number. I could also go to a different or a exchange if I wanted to, but I'm just going to take the total, and that will show me all the stocks hitting 52-week highs. Now I want to search this table because I want to know which REITs made it there. And so what I'm going to do is I'm going to type in real and estate, and that's going to filter out everything that has the word, or filter in everything that has real estate in it. So that will be that sector there. And you can see all the new highs related to real estate. Now we got some Canadians on here as well. I could go back and just choose NYSE or NASDAQ. But you can see between the NYSE and the NASDAQ and the Toronto, we have like 38 new highs in REITs, specialty REITs, retail REITs hitting new highs, specialty REITs. So a lot of strength in that group right now. So now we're going to hit the sectors, all right? And I'm going to do the big sectors first. And what I'm watching for is this first support level, and I raised it. It is now based on last week's low. So there you can see XLY, all right? It's below that December high there that you see, all right? It's right near the 200-day. Amazon reports soon, but there's support. As long as support holds, the bulls get the benefit of the doubt. But if we break support, then that's going to be a bearish development, and if RSI moves below 50. So that's one sector, and what you can do is you can tally these up, and when the majority of sectors break support, especially the 6 big sectors, technology, communication services, healthcare, industrials, finance, and consumer discretionary, when all those break support, or 4 of the 6 or 3 of the 6 even, that's going to tilt the balance. So we can see XLY is holding up. Communication services is also holding up. It's kind of gone flat the last few days. You can see it's gone nowhere. It's been up and down, above and below 44 the last 3 weeks, but it is holding above support, below that December high, below the 200-day. So watching here, if it breaks support and RSI breaks 50, that's going to be the negative. XLK, similar situation. Look how far below it is from the December high and the 200-day. All right, could it run further? Definitely, because the trend is up. All right, the trend is slowed. We had this, surge, and it's slowed right here, but it hasn't reversed. So I'll be watching 64 there, and if we break that level, then that's going to be the bearish development, and RSI breaking 50. Incidentally, the reason I've got the red on RSI is because typically RSI meets resistance in the 50 to 60 zone when the bigger trend is down. It did that in November and in December. It's doing it now, and usually when it goes below 50, that signals a downturn. So that's what I'd be watching for. Financials. Now, financials have been the strongest, all right, because the RSI for financials almost hit 70 during this recent run. So its RSI reading was the highest in January. And it's very close to the 200-day, but it's still below that December high. So, a big advance, but guess what? This is a bigger decline, all right? And the bigger decline is bigger than the advance. And so that's net bearish. And it's coming off a 52-week low. So first support for finance marked at, we'll say 25.4 for a buffer. And then we look at industrials, consolidating here the last 6 days. Maybe they got this pennant thing going too. And if they break out of that pennant, then that's going to be a bullish development. Keep an open mind. We could break out. We could run to the 200-day and then have a reversal. As I said, I'm pretty much tactical at this stage because as far as, a longer-term strategy, we're in a bear market, I think. I haven't seen enough evidence to suggest we are out of the bear market. Materials, similar situation, stalling, and there is support at 52. Energy, similar. They're all the same situation, just at different degrees. Some are closer to the December high, some are further. But oil, the XLE is just stalling, and if it breaks down around 61 and change, that's going to be bearish. Healthcare. Now, healthcare got hit really hard the last 3 days here, and it's one of the weaker sectors over the past 5 days. You can see that it did break its first short-term support level. It's right at that 200-day. But, I do view that as a double top, and it was confirmed with that support break there. That's a big break there. We got a big oversold bounce, and even though we came back above that breakdown there, it's still a counter trend bounce, and I'm expecting a continuation lower. Consumer staples, I think, is one of the weakest sectors. Procter & Gamble is basically holding it up. You can see it's 14.3% of the ETF there. So you can see a support break there in December twice and a bigger support break. And we've rallied back to kind of this break zone. And if we break support there, that argues for further weakness. I think breadth-wise, consumer staples are one of the weakest. Utilities still holding up, still working their way higher, broke above that January high and fell back a little bit, but one of the stronger sectors. And now we get to the leader recently, REITs. I mean, look at this V and the breakout and the big move higher. Hard to employ technical analysis on this other than catching the swings, but it's clearly one of the stronger ETFs right now. Now looking at the industry group ETFs, I think I got 10 of them for you. Now here's housing, home construction ITB. One of the stronger ones for the simple reason there's that December high and it cleared it. And then it fell back with the flag and it's trying to break out of a flag. But, you know, if it moves below that flag low, then that pattern is negated. And keep in mind, we're below the falling 200-day moving average. So the trend is still down for housing. When we look at retail, and this is one I would focus on as far as the consumer discretionary sector is concerned. I mean, first of all, look at this decline from November to December. Huge decline. And then, you know, just look at the decline from December. That's a big one, 47 to 38. And we've had a monster rally, but we're still below that high. We're in that 50 to 62% retracement zone, and we're stalling. So I'm watching support. The gap held. So I still give the bulls the benefit of the short-term doubt here because of the gap and the short-term uptrend. So maybe we work our way towards that 200-day. But if we break support at 43, that's going to be the negative development. We look at Sky, cloud computing. This is one of the ETFs that broke above the December high there. You can see, so it's one of the leaders, and it's got this gap that is kind of holding. And then, of course, I've got support there marked at 51.5. Hack, the Cybersecurity ETF, has a gap up, and that gap pretty much held yesterday. So it's doing all right and could be ready to challenge the 200-day. And you can see I've got support mark there. You look at the First Trust Internet ETF, and it's holding up as well. It moved above that December high, so some relative strength. And I think it's fine as long as support holds there from last week's low. The Semiconductor ETF, look at that big 2-day surge. And then a big drop, a weak open and a strong close yesterday. That's why you have the white candlestick. The way candlesticks work here, you have the open there, and then you have the close at the top. How do I know that? Well, it's because it's hollow or white. And when it's filled or black, that means you had an open here and a close here. So you sold off after the open. We look at software, challenging resistance there, still in an upswing. I need to raise support to last week's low. Oil and gas equipment services, as I'll get on to oil next. Oil's still in a long-term downtrend, so I can't get too excited about this one. But support right there at 10.3, 10.35. Watch that level. Biotechs got hit yesterday. So you can see there that they had that surge up to the December high, but didn't quite break above it and then stalled here. So watch support at 106 because a break there would be bearish. And then when we look at the Biotech SPDR, we can see a similar situation below that December high, stalling and watching support. So the more support breaks we see, then the more bearish. But as long as most of them hold support, we could continue higher short term. Now let's look at the intermarket arena as the Fed meeting starts. So the Fed will make its announcement tomorrow afternoon. I am not going to speculate on the announcement or the market's reaction to the announcement because, you know, trying to get this right is really a lesson in futility because you have to get two things right. First, you have to get the Fed language right. And second, you have to get the market's reaction to the language because you know what happens is the Fed will make a statement, the market will react, and then we'll go and find what in the statement matches the reaction. All right, it's not like we're going to, you know, pick the reaction based on what we think is going to be said. We pick the reaction based on what was already said. So I don't think there's any help in doing that. So if we look at the bond market, which typically leads the Fed, all right, what we can see here is TLT has broken above its 40-week moving average there, and it is broken out of that wedge. And then is consolidated above the break there. And you can see that's kind of between a rock, which is resistance, and a hard place, which is the 40-week moving average. So basically, it's gone nowhere, and we're waiting for a resolution here to see what will happen. And if we get a break to the upside, that's going to call for higher bond prices and lower yields. You can see the 30-year yield down below. If it breaks down back below, then that's going to be negative for yields. When we look at the 7 to 10-year Treasury bond ETF, we can see a similar situation. But look at this, we have a breakout there, and we're holding just above the breakout there. And with Treasury yields, the 10-year yield, we broke below support and the 40-week moving average, and we're holding that break. And so as long as we hold below that break, then that tells me that, or suggests that yields are going to be moving lower. But if we move back above, that's going to suggest yields are moving higher. So watch this for the directional break out of this little consolidation. Then we look at oil. All right, this is a weekly chart for continuous crude, and I think this is the way you have to look at oil. Oil's in a long-term downtrend. All right, it's below its falling 40-week moving average. It hit a 52-week low in December. It's had this big bounce, all right, but this is a counter trend bounce, and it's hitting resistance there. So I would be on guard for a potential reversal here and a move lower in oil because the longer-term trend is down and we're at resistance. And then if you look at USO, which you can only use for short term, you can see that there is a resistance level, and we had a sharp move lower yesterday. We broke, last week's low, but there's still support there. And if we break down further, that would call for a test of those December lows in oil, and that could negatively affect some of the energy-related stocks. Now, gold continues to benefit from whatever uncertainty. You can see that we have 3 breakouts on this chart. The first breakout was in September, had a pullback, another breakout in November, a break above the prior high in December, and now we consolidated for 2 weeks and broke out with a surge last week. So that breakout is still holding. Overall, gold has gone nowhere. It's been in this huge sideways pattern, but the natural target would be up there around 128 for gold. And finally, the good old greenback, okay, because gold takes its cue from the dollar usually. The dollar, of course, takes its cue from the euro because 57% of the dollar ETF is from the euro. And if you look at the dollar, it's corrected a little bit, but I would watch out. It looks looking like it wants to break out. And this is a correction within an uptrend. I think this is an uptrend here. So if the dollar breaks out, that could weigh on gold. If you look at the euro, it's consolidating. Watch for a break there to continue lower. And the yen, watch for a break to the upside there. And just to note that you can see on trend on Stock Charts TV. There's a link for Stock Charts TV at the top of our web pages, and you'll see what's currently playing there. And if you scroll down, you can see the schedule for upcoming shows. And there you have On Trend at 10:30 a.m. and 11 a.m. Eastern. And when we get that archive up on our YouTube channel, you can click on the replay link to be taken to our YouTube channel. And if you scroll down there, you can see the archive for On Trend with Arthur Hill, as well as the other shows. And if you click on that link, you will see all of the On Trend videos on the right. And that concludes this edition of On Trend. Thanks very much for tuning in, and remember to stay on the right side of the trend. Have a great day.
Is your portfolio positioned to profit from continued market volatility in 2019? Join over 100 investing and trading experts, including policy guru Steve Forbes, emerging markets icon Mark Mobius, America's best income investor Bruce Johnstone, elite energy analysis Stephen Schork, and trading visionary Tom Sosnoff at The Money Show Orlando to get the best ideas for protecting and growing your investment portfolio during 250 in-depth presentations. Claim your free pass now at orlandomoneyshow.com.